remote.
Oh, that makes sense. Sure, because everybody else is, yeah. Well, Zayla, what do you think? You think we're ready to go here?
I think we are. We have like close to 60
That's great.
people.
That's great. Great. So welcome to the webinar hosted by Catholic Investment Services. Thank you for joining us today. This is the first episode of a new series entitled Managers in Focus and features CIS Board Chair and Founder Scott Malpass and Chris Begg, Co-Founder, CEO, and Chief Investment Officer of East Coast Asset Management, one of the equity managers for the CIS Catholic Endowment Fund. My name is Tom Lanctot, and I am privileged to serve as Chief Executive Officer of Catholic Investment Services. My colleague, Zayla Estarjan, has done a great job organizing this program and is at the Zoom controls. Enormous thanks to our two accomplished panelists, who you will meet shortly. Today's format will be conversational. There'll be time for audience questions during and after the formal part of the program. So if you have a question, please use the Q&A feature on your Zoom screen to submit your question. Our audience is muted. The program is being recorded and will be available for replay on the webpage of our CIS Institute and in podcast format. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address investment challenges faced by Catholic organizations. We are a Catholic nonprofit providing investment solutions for other Catholic nonprofits and their investment consultants, and now manage over $1 billion of client assets in 4 different strategies. We hope that this program provides some useful take-home value. Before we begin our program, please join me in a short prayer. Lord, let us redouble our efforts to be instruments of your peace and to pray for and help where we can those whose lives continue to be disrupted by the pandemic and Hurricane Ida. We pray especially hard for the people of Afghanistan and Haiti, for peace in our cities, and for the safety of the men and women who serve us as first responders and in the armed forces. Finally, we remember and honor the victims of September 11th and their families. Amen.
Amen.
As many of you know, CIS Board Chair Scott Malpass is the retired Chief Investment Officer at the University of Notre Dame, where for 32 years he was responsible for investing the university's endowment and other assets. Notre Dame's endowment, I think, Scott, this is still true if it's not a lower number, but Notre Dame's endowment is the 7th largest private university endowment in American higher education and the largest at a Catholic university. Institutional Investor magazine has called Scott an investment titan and MVP, and he certainly is all of that and more for CIS. Scott originally met Chris Begg and his firm through Scott's work at Notre Dame, and we're excited that East Coast is now partnered with the Catholic Endowment Fund. In a recent investor letter, Chris included a great quote as follows: "Talent hits a target no one else can hit. Genius hits a target no one else can see." So I'm pleased to now have one investment genius, Scott Malpass, introduce us to another, Chris Begg. Scott, thank you.
Thanks so much, Tom, and good afternoon to all of our friends and clients. We really appreciate you spending an hour with us this afternoon. I really was looking forward to our time today. Chris Begg is a good friend. You know, I've probably hired or fired, I guess, over 400 investment managers over 35 years. And Chris is really one of the best and most thoughtful investment professionals that I had the pleasure of working with. He really is a devotee of Warren Buffett and Charlie Munger. A lot of people say that, but it's actually true in Chris's case. So it's great to have Chris here. Chris is the Chief Executive Officer and Chief Investment Officer and co-founder of East Coast Asset Management. Prior to that, Chris worked at a firm that I knew well called Moody Aldrich Partners. Prior to that, he worked with another Boston-based firm, Boston Research and Management, where he was a portfolio manager. He's also, and very importantly, an adjunct associate professor at the Heilbronn Center for Graham and Dodd Investing at Columbia Business School, which is a very famous program, of course, where he teaches security analysis. He's a New Hampshire graduate from International Affairs and Business. He's a CFA charter holder and a member of the Boston Security Analysts Society and the CFA Institute. I got to know Chris very well 6 or 7 years ago, and he's one of the rare professionals that actually, investment professionals that actually does what he says he's going to do and achieves the kind of performance that we think is reasonable and that he's talks about when you're just getting to know him. So very proud that he's performed 16% a year since they founded the firm. That's 5% over the MSCI World Index. So Chris, welcome. Thanks for spending time with us. It's great to see you. There's a lot to talk about today. And so maybe we'll just start with a little bit of history you can talk about the organization and the firm and some of the key tenets of your investment approach.
That sounds great. Thank you, Scott, so much. And thank you, Tom, for the introduction and the prayer. It's to hear an introduction like that coming from Scott Malpass is pretty, I appreciate that, Scott. It's been an incredible partnership working with you over the last, 6+ years and getting to know you in our firm. Yeah, so East Coast Asset Management, we've, founded 12 years ago. But prior to that, I spent my first 10 years in the business, like Scott had said, at Boston Research and Management. And, that first 10 years was very, very important for how I, thought about investing. And it gave me an opportunity just to read a lot. And sometimes I think you have the luxury in this business to have a great mentor or to find great heroes. Scott alluded to the fact that Warren and Charlie have been really important heroes of mine. And during that first 10 years, really trying to understand what value investing meant. And what really resonated with me was kind of what Charlie Munger brought to Berkshire Hathaway and to Warren's kind of his thinking which was, if we really care about compounding capital over the longest period of time versus having to buy and sell lots of securities, it made a lot of sense to me. If we could just find great companies and buy those at reasonable prices, that approach seemed to fit my temperament as an investor, which was to think over very long time horizons. So I was always impressed when I read, Warren Buffett's early partnership letters, where he was very focused on the idea of compound interest. And he wrote these early essays. There were 3 of them called The Joys of Compounding. And what he said is, if I lived over a very long period of time and I had this rate of return, which was in excess of the market, the results would be astounding. And, looking at 55 years of Berkshire Hathaway and another, 10 years of the Buffett partnership, that's exactly what happened. And one of the things I forced myself to do to think non-linearly about compound interest is just to look at those tables. And when you start compounding at 16%, 18%, 20% over long periods of time, the results are absolutely extraordinary. And you have to continuously, even as an investor, remind yourself of how powerful that is. And, working with Scott, who's done that for over 30 years at Notre Dame, is case in point. And it's what we've tried to do East Coast for 12 years and for 25 years of my investment career, is to try to reduce the frictions and allow this compound interest to benefit over a long period of time. So, that first 10 years led to an opportunity to join Moody Aldrich for a couple of years. And I worked with a great investor named Amory Aldrich, had a 30-year incredible track record. But there was a point in time where I really wanted to start something that I could really build on my own, and had a great co-founder named Ben Favazza who was interested in running all the operations, so I could focus 100% of my effort on research and portfolio management and investing the capital. And that was the genesis of East Coast. And we're a 3-member investment team today. My partner, Scott Bradford, and we have great analyst, Jimmy Crockett, who's been with us for 7 years. Scott actually recently joined us about 2.5 years ago. He was one of my first friends in the industry. We worked together side by side when I was at Boston Research. He was at a firm called Altera Partners for 17 years. And there's no one I've worked closer with independently. And he, 2 years ago, left Altera as a partner and was looking for his next, whether he was going to go off on his own. And we decided to come together, and it's been an incredible incredible inflection in my career to be able now to invest alongside someone I respect so much, who shares the same pattern recognition around exceptional companies. So we're having a lot of fun, and to go into a couple of the situations that we had over the last couple of years with kind of a joint partnership around pattern recognition has been really profound.
So Chris, reading some of your letters, you absolutely take a more interdisciplinary approach to inform your philosophy. Maybe just share how that's evolved over the years.
Yeah, when I think back to what makes Warren and Charlie such a great partnership, I think that there's a unique skill set they each bring. Charlie, I consider Charlie much more right brain, much more interdisciplinary, where he's looking not just around investing in business patterns, but across a wide range of patterns, whether it be physics and biology, human history, biography. And Warren, over a lot of his, was much more left brain, much more analytical, much more to the numbers, more Graham, and the way that Graham wrote security analysis was much more, let's deconstruct what these assets are worth and buy them at a discount, versus seeing the entire picture, which I think Charlie has really brought to the table. So when I think about my own quest of learning, it was always about, how do I become not just one dimensional in any one of those things? Meaning, I didn't want to know just a little bit about a lot of things. I wanted to know a lot about a lot of things. So it was really, 10 years into my career where I thought I had learned a lot about the niche of investing, that I wanted to broaden that. And I needed a system to broaden so I could go deep in a lot of areas. So about 10 or 12 years ago, I set up a habit around allowing myself for 3 months to pick a topic that interests me. And I wanted to go as deep as I possibly go, but I would set a limit to that, and that would be 3 months. And, most recently, the topic of this quarter is superconductors. Interesting topic, something I've always interested in, but I wanted to go as far back as I possibly could, understand the genesis, the origin story of it. How has it evolved? What's the current thinking? And then to this day. And then the prior quarter was humpback whales. And so these things have helped me gain a deeper awareness of pattern recognition across a lot of different disciplines. And then, are any of those applicable to this art that we're trying to be masters at, which is compounding capital at high rates of return over a long duration? And Charlie being kind of a hero of mine in this regard, Peter Kaufman is another one. I find it to be a real advantage in thinking. And Ben Graham, which is the class that I'm lucky enough to steward at Columbia for the last 11 years, he would open his course with a quote by Spinoza. And he said, if you're to be successful in investing, you want to see things in the aspect of eternity, sub specie aeternitatis, which was, and I said, eternity, that sounds like a very long period of time. But what he meant by eternity is, how do we see the entire picture? And I think by thinking and learning interdisciplinary, it allows you to look across the time scale of all of physics, all of biology, all of human history, because our investing timeline is about 100 years. In the early part of 1930s, when Ben wrote security analysis, it wasn't even investing, it was speculation. It was railroad bankruptcies, and you read that textbook and there wasn't a lot of investing happening. Seemed like there was a lot of gambling happening, right? And so I think to have a unique advantage, I think, in this industry, what I feel helps is to have this interdisciplinary approach to learning.
I was going to say, for enduring success, you've often talked about a more holistic view of your work, and you really put that into practice. And you've talked about a little bit of that, but you really do put that into practice. One of the core tenets of your work is to focus on exceptional businesses. Can you share how you define and source these types of businesses, Chris?
Yeah, that core tenet, back to what we're trying to do, align with compound interest. And what we realized that what made a lot of sense is focusing on the small segment of companies that we thought were exceptional. And the way that we define exceptional, the most important thing is, does the business earn high returns on invested capital? And are those durable over a long period of time? And what we mean by a long period of time is we're really trying to buy a company that we think its moat will be as good or better over a 10-year period. And a lot of our peers look at 3-year, 5-year. We're really trying to elevate our perspective to really think 10 years. And what often happens with a company that we think a moat might be 2 years or 3 years, it happens sooner. So with that 10-year perspective, it really forces us to be really adamant about having a very high threshold of what that moat is. So if you were internally into our office, you'd see probably 90% of our conversations are around what is the competitive advantage and why is it durable? And there's never one. What we've really talked about even more lately is what are the layers of competitive advantage? And so we think there are 8. Is there a structural competitive advantage? So structural would be, is there a natural duopoly that exists? Is there a natural oligopoly? Is it a monopoly situation? Which we think some monopolies are natural, actually, like in the case of Google. Is there some type of exclusive period that the company enjoys through a patent or through a sole source thing? Is there some type of, we call something called a Switzerland of X? Is there a Switzerland situation that's structural? The second is there are scale advantages. Scale advantages come from R&D scale, from advertising scale, from distribution density efficiencies, or from operational scale. Another advantage would be, is the company have some type of scale economics shared where they're sharing their scale economics with the customer in form of lower prices or even more services. So we saw this with Amazon Prime when they launched that, or with Costco, and still to this day, Costco. Is there high switching costs? Is there a customer mind share that exists through a brand or awareness around the company? And then most importantly, I should have mentioned it higher in the list, is network effects. And then if you achieve all the 7, if there's different layers of the 7, maybe the company has 5 of the 7, what generally happens if it's durable is they built a cultural competitive advantage as well. And if that cultural advantage is there and it's strong, we think it gives the other advantages even more stickiness. So that's it. It seems like just one part of the process, but literally this morning, Scott, Jimmy, and I, we had a new company come across our source, just sourcing categories yesterday. Happens to be a SPAC that we think there's clouds around the SPAC industry, and there's likely some things that are mispriced in there. We spent 4 hours this morning just thinking about the moat of this business, and just internal debate, and it's really fun. But even before we're going to build a model, like we really try to understand that moat really carefully. So the other 2 things, Scott, is just defining exceptional business is secular tailwinds. We really want exceptional businesses that don't face headwinds, but then have some type of secular tailwinds that's driving top line growth. It's also not going to disrupt the business. Say if something's had add-ons with climate change, or you look at some of what's happening in autonomous driving or EVs, and being on the other side of that, we think is difficult. And then the third is we typically like to align ourselves with great capital allocators that have skin in the game. And those are the 3 things that really define, a great business for us or exceptional business for us. And the bulk of our work is putting all of those names into what we call the Grove of Titans. And the Grove of Titans is a list of about 80 businesses that we have completed work on, and another 100 that we think are really exceptional, but maybe we haven't spent the 3 to 6 months of work on, but they're really identified as being exceptional to us. And these are both US companies and they're non-US. The universe will increasingly become more non-US, we believe, but we're really trying to be unconstrained in where we're sourcing, both in market capitalization and in geography.
Portfolio concentration's been a hallmark of your investment philosophy, Chris. Maybe just share how you feel that concentration improves your risk-adjusted returns over time.
Yeah, so we've gotten more concentrated over our 12-year history. And the reason that's occurred, I mean, our original concentration was around 15 to 20 businesses.
Mhm.
And today in the Partners Fund, that concentration is around 6 to 10 businesses. Today we own 7. And we've become more concentrated for 2 reasons. One, we want to concentrate really in and on our best ideas. And so the first is we really don't think at any one time there's enough good ideas that we think have the same merit of deserving capital. So at any one time, we think there are generally clouds that create a pricing opportunity to own one of these exceptional businesses. And it's fairly rare, and it's usually unique to the business or sometimes the industry. And so when we see those opportunities, I mentioned humpback whales, we intermittently feed. We feed very heavily when we have those opportunities. Like in March of 2020, we were feeding heavily on aerospace parts companies. We put 20% of our capital in 2 names over a course of 3 weeks. Earlier this year, one of the more deserving places in our portfolio was some of the digital advertising platforms. And hiding in plain sight, everyone seemed to have an opinion about what these businesses were, but these were 15% or better IRRs over 10-year modeling periods. So that was deserving of over 25% of our portfolio. And so that's generally how we work. We really spend a lot of time on the growth, and we concentrate when the IRRs are most deserving. And just kind of portfolio construction, we're really just looking at, every week we just look at the IRRs of the portfolio and we say, which is demanding more capital and which is less deserving of it. And it's not easy, but we really try to be disciplined and patient around that value equation of what are the IRRs telling us to do, and that determines concentration. And the other thing is, that how do we lose? We think of mitigating risk. Like Scott and I both, when we go to bed at night, we kind of go through that portfolio and we say, how do we lose? How do we lose? And let's run a probability tree kind of equation to say, okay, no, you can't lose there, can't lose there. And we try to figure out the asymmetries of these IRRs, of course. But if we had 20 companies or 30 or 40, I think that's really difficult to do. But at the end of the day, I think we own a conglomerate today of 7 of the best companies in the world. And if I own those personally, if my family own those 7 businesses personally, would I say I'm adequately diversified? I would say 100% I'm adequately diversified. These are 7 of the most incredible companies, and we own them at good valuations. And so that's how we feel about concentration. And we think that's going to be what has and will give us that, the alpha or the excess returns over a long period of time for our partners and for our own families.
You talk in your annual letter about the source-built arches of portals, bridges, and domes, which I thought was fascinating. I know we don't have a lot of time to go through it, but maybe just what does that mean, and how does that inform your investment approach?
I brought a little prop with me, Scott, since we were with the Castle Investment Services. So here's my prop, right? My prayer beads. But this is Robert Hooke in that letter talked about, how he figured out how to build the dome of St. Paul's. And Robert Hooke figured out the equation, which was basically this. He said, here's this is a catenary arch, really. You have perfect vectors of tension running down this. If you invert that, you have perfect vectors of compression. And so how does that apply to investing? And that was the secret to figure out how to build the Arch of St. Paul's. And another quote that was really important as I was thinking about arches was Leonardo da Vinci defined an arch as being where 2 weaknesses are brought together to create a strength. And when I thought about great businesses, there generally was information moving through that arch, and on the other side, there was value being created. So the example in the letter that I reference is, look at Amazon's history, right? Amazon was created as a portal to buy books. This is say the portal, and let's put books online, and you can go and you can buy a book. That's your 1P business model. is there something we can do at a higher dimension than 1P? We could do a 3P. What's 3P? How about anyone else that wants to sell something can use our platform to sell their goods and services? Now, over 65% of all Amazon's goods are 3P. And it's a platform that has a flywheel effect that more and more use, you have a, so what the portal became a bridge, right? The 3P is a bridge. Higher order, more value creation. Is there a way that we can get the next level, which I refer to as a dome? And so what is a dome? A dome is something where you reduce search cost to zero. If you're going to buy a good on, you need something in the next 2 days, you just go on Amazon, it's got your credit card information and it's there in 2 days. That became Amazon Prime. And Prime was a dome. I think, Jeff learned a lot from what Costco had built. And so it just gave us a gradient of language to talk about the exceptional companies and how each level was an order of magnitude of more value creation for that business and for their customers. And so we saw this in Google. And so it's a high bar that we think about, so some of the language we'll use internally is this a dome? And it's usually there's a dome element to things that are virtuous as well. And so what we've seen in employees want to work for virtuous companies that are purpose-built. And so being a dome also has to do with how you treat your counterparties. How are you treating suppliers? How are you treating customers? How are you dealing with enforcement agencies? And is there a win-win to all of those counterparties that may not be perfect, but that was kind of a bar that we were looking for when we wanted to compound capital at 10-year plus rates in exceptional businesses that were really reducing friction by doing something cheaper, better, faster than had been done before.
Our investors, our Catholic investors, think a lot about Catholic social teaching and the impact of that on the portfolio. At CIS, we try to combine superior active management, which you and your other peers provide us, with the appropriate screens that reflect that. But more recently, ESG considerations are on their minds. Maybe just talk about how ESG might inform your decision making as well, Chris.
Yeah, no, that's great. What I referred to just subtly was this idea of what I call the essence of win-win, right? So the essence of win-win was, do I have a win-win with all counterparties of a business? One of those counterparties are not just the obvious ones like shareholders, customers, enforcement agencies, suppliers, but it's the community and nature at large. And if you have a win-lose with any of those counterparties, you basically have set yourself up for a win-lose that will determine your unsustainability. You will not deserve to be relevant, particularly I think in the world that we live in today. And so when we're looking at screening for asymmetry, we feel we can't underwrite things that are win-lose with nature, or win-lose with climate change, or win-lose with DEI policies. Eventually, it'll be unsustainable. Employees will leave. Shareholders will lower the valuation multiple. So, here's one of my other props that I keep on my desk. This is a deck prism, and a deck prism has 6 sides. And this was found on a whale ship, and it would actually light up the bottom of a boat. And this reminds me of those 6 counterparties of the institution. So it just sits on my desk, and it's just a reminder to kind of make sure that we're looking through the eyes of every current counterparty in the business to see if there's a lose that ultimately could create a loss for us. That might be a blind spot, if we don't look at it that way.
A lot of investors, Chris, are trying to achieve a inflation plus 5% or so return. Obviously, keeping up with inflation to preserve purchasing power, and then 5% for spending. That's been difficult to achieve for a lot of investors over the last 10 years. They've had to be much more creative. They've had to be willing to do more in private equity, et cetera, other kinds of assets. Do you think that's going to continue to be difficult to achieve? And maybe just comment on your thoughts on that might be helpful to our investors.
Yeah. So we've had 30 plus years of declining interest rates.
Mm.
We're at a point where there's some uncertainty on what the direction of interest rates and inflation will be. But when you look at the current static returns from the various asset classes, it is definitely challenging to kind of look at CPI plus 5. When Scott, myself, and Jimmy are kind of looking at our universe, in aggregate, we're turning over lots of stones and not finding the IRR thresholds we want. We're looking at 15% or better on entry. And if we underwrite those conservatively, we think we can do even better by having optionality in those ideas. That's actually, made us a little bit more concentrated to start the year in those things that we were finding were 15, 16s, or that we owned that were more deserving. And so that level of concentration gives us the ability to make very targeted bets when we are being compensated for it. But if I'm allocating across a very large pool of money, and I'm looking at my asset classes, I am a little bit more concerned at where those static IRRs are today. Even with the returns we've had this year, which have been, we're up about 22% in partners this year, we're still finding mid double-digit IRRs from today's prices. And remember, this is a 10-year underwriting process, and we have not changed our terminal multiples in lieu of this lower for longer interest rate mandate. We've held our terminal multiples the same as we've underwrite these businesses 5 years ago, or 7 years ago, or 10 years ago. And so we're still finding things to do, happy with our portfolio, but I agree with you that from today's prices, some of those returns are going to be challenging in certain asset classes.
Actually, we just got a question in from a listener about, the question is, how do you find these businesses at reasonable prices? So getting at the valuation aspect, maybe just talk about that a little bit more, kind of how you see things today.
Yeah, so the way that we think about valuation, simplistically, you would say, what is, when we get a clean adjusted free cash flow number on a business, we can compare that to the enterprise value, and that would be a yield, right? What is our free cash flow yield today on this business? And oftentimes we have to clean up that adjusted number pretty carefully. And what is our growth algorithm, right? What do we think the free cash flow is going to grow at over a 10-year period? So we really deconstruct top line growth driven from secular tailwinds to pricing, to units. Is there margin expansion? Is there some leverage on the balance sheet that gives us a little bit of excess in our algorithm? So what's our growth? And, free cash flow yield plus growth, terminal multiple, we're able to build a 10-year DCF to determine what is this business going to deliver from today's price. And when I look at my universe of the Grove, there's a lot of high single-digit IRRs. Mm-hmm. And it's fine. Some of my favorite businesses in the world, I'd love to own. MasterCard, Visa, Moody's, Copart, they're not there for us today. They will be, maybe someday in the future. So we're just really disciplined and patient about, this is our exceptional quality threshold. What is deserving of capital? And so what generally happens, Scott, is there's a cloud, and the cloud gives us, gives us that opportunity to make a large bet when everyone is very short-term focused on something. In March of 20, it was, hey, we're not going to jump on an airplane for a long time. I'm going to wait till the dust settles before we play in aerospace parts companies when TSA volumes are 95% off. Earlier this year, maybe it was regulation around some of these platform advertising, digital advertising businesses. It certainly, felt that way from the IRRs that we were seeing and continue to see there. But we're always looking for clouds. And that's usually where we're going to find the opportunities to buy these things at reasonable prices.
So maybe just elaborate a little further in terms of some of the main themes in the portfolio today, and maybe some that you're considering for the future.
Yeah, so 7 companies in the portfolio. 40% of our capital is in, 2 wonderful, monopolies in digital advertising. And we're real excited about a lot of our optionality around what those businesses, and also there is a fair amount of offense defense there. Not only are these growing at still incredible rates, There's this incredible offline, online secular tailwind, but there's also a lot of R&D that's going into new businesses that we don't have to pay for. Meaning we're not paying a high multiple for what those businesses could deliver in the future. And so that is still really compelling to us. And, we look at, something like, say, Facebook, which you look at their ARPU numbers in their non-US businesses, which is the bulk of their users. I mean, it's just a pittance compared to where it is in the developed markets, where it is in the US market. And our channel checks suggest that these will be materially higher. And so the other thing that's still a focus in our portfolio is we still own, 2 great industrial businesses that focus on aerospace parts. These are sole source companies on 50-year, airframes that they're able to sell. They're the only, provider of that part. And that gives us a really structural competitive advantage as travel starts to come back online and we start seeing those revenues come back on. And those are still really compelling IRRs. We own an incredible cable business in Charter, which is still a really attractive IRR with really good capital allocation and run by the #1 cable CEO, Tom Rutledge. And we own, we just invested in a new business that we someday will be able to share, but we're still in the market on it. But that was another, it's a software related business, non-US, smaller on the market cap scale. It's a $3 billion market cap that, is just hiding in plain sight, where all these SaaS businesses are just very expensive. We were able to find one for certain optical reasons that we're really excited about. And we've brought that in this portfolio, and we've continued to try to build that to the size that we want it to be.
You've talked a little bit about your team, Chris, but maybe just elaborate a bit more on the organization and, kind of how you built the team, how do you incentivize your staff, what's the difference between performance incentive versus management fees and that kind of stuff.
Brilliant. Yeah. So really we've thought a lot about how do we reduce frictions so that the investment team could focus 100% of their time on research and driving returns. And so, Scott and I were really adamant about how we need to architect it early on so that those frictions just don't come into our day-to-day, which is going to take away from what we really love to do. And, so we have a great ops team, and, Ben leads it up, our CCO and COO, and it just takes so many of the frictions off of our plate so we can focus, all of our attention. And we want everyone aligned with our partners and with our portfolio. So, our management fee is a loyalty-based management fee. So each year that a partner's with us, their fee goes down. And we think that gives a differential benefit to, those partners that have been with us a long time. And then our performance fee. If we are successful over a long period of time against, against absolute returns, we think we should be rewarded, but we want to reward our team by reinvesting those performance fees in our fund. And so, those will vest over a 3-year period. And so we do that with everyone, including Scott and I and Jimmy and the rest of the team, is those performance fees are reinvested so that we have more and more capital really aligned with our partners' capital. And that's been it gets everyone pretty excited when we're have a good year and that they're seeing that their own family wealth is growing too.
Question came in, Chris, about people are listening to your philosophy and assuming correctly, you have longer holding periods and less turnover generally than most of your peers. Maybe what is your average holding period and turnover?
Yeah, the ideal would be forever. We can own a company forever. It'd be great. And some we've owned for a very long time. TransDigm, which is one of our aerospace companies, we first owned it in 2009. So we recycle a lot of those exceptional businesses over time. I think if you were to statistically calculate our turnover, it would probably be somewhere in the 20% area, and it's usually intermittent. Like I said with our whale analogy, in January of 20, we were ended up selling some things at valuations that were just, high single digit. It made, we had some capital available to do some, some really intelligent things we felt in March of 20. Right now, our cash build has moved to 10%. That's not a market timing call at all. Usually something will exit a portfolio on valuation, and it'll take time if we're building and finding, volume. But typically our cash position ends up being, hovers around 4 or 5 or 6% historically. So those are kind of how the metrics work out, but it can look very different at any point in time.
So Chris, we all make mistakes in investing. I've certainly made my share over time, but you make just enough to offset that and earn really good returns. So when you've made mistakes, has there been a common thread to the decision making, or can you look back? I know you've done the attribution very carefully because you're so thoughtful, but has there been any sort of common thread to those mistakes?
The one that comes to mind that, when we looked at the structural advantages of moats, what we realized is even though a company might have a moat, if it faced a secular headwind, that it didn't matter if the moat was there for the industry, that the industry was terrible. It was going to be the industry that won, or the headwind that won. So I guess we've held a higher bar to kind of thinking about those secular headwinds more carefully. And so when you look back at the record, like when there was a time where we would include some industrial companies that had a lot of, say, commodity related exposure. And so we had those commodity price dislocations, this is around 16, those investments hurt us. And it was hard to kind of look forward and say, are these coming back? I don't know. Like, what are commodity prices? And so we became less willing to own things that had a lot of commodity price exposures. And that may be a common thread in other, investors as well. But, we lived that lesson, and
we live that too. So we're in good company.
So luckily it didn't, hurt our record dramatically, but we would have loved to attribute those returns somewhere else.
And I just encourage our listeners to keep asking good questions. Here's one, Chris. How do you think about disruptive innovation as a competitive threat, given your long time horizon and the fact that you're investing in leading companies? So disruptive innovation as a competitive threat.
Oh, it's huge.
Yeah.
That I shared with the audience that we're looking at a business this morning, and this particular business, as we looked at the 8 layers of competitive advantage, they probably have 5 of the 8, maybe 6 of the 8. And the one thing, as I thought about it, there was one disruptive innovation in this industry that could completely change this business. And so that's our focus point, right? That, okay, if this were to happen, do they even have an exceptional business anymore? And so, we have some great, paths to find some answers to that. And, but yeah, no, it comes in 2 forms. It's a great question because it really speaks to the secular headwind, which is, okay, here's the disruptive thing that's going to eventually affect the business. Therefore, do we want to play? And again, we have a strong preference for secular tailwinds, but it's not a hard filter. We'll still play in areas that we think, we have a 5-year great runway. And then that moat problem, if there's really disruptive technology out there. Yeah.
So Chris, here's a question that doesn't really apply to your not-for-profit clients, but given pending tax changes with long-term capital gains potentially increasing, is there any thought to have sort of planned sales and reinvest in this calendar year to lower your overall tax liability?
Yeah, we have a lot of nonprofit clients, our endowments, our foundations, but we also run a lot of capital for taxable clients. And we are taxable investors in the fund. An outcropping of the way we invest tends to be very tax efficient. It's not by design, but we're interested in superior returns over a long period of time, and while mitigating risk. And our style on these long holding periods, owning things that are just going to just do well for us over time, happen to be a very tax efficient approach. But we're not doing anything that for tax reasons in 2021 that we haven't done in the past. We're really selling things on valuation concerns and buying things that are more attractive. Yeah, but nothing, no tax strategies at work, but we are quite tax efficient.
Another question, Chris. How do you engage with and or build relationships with the management teams of the companies you own?
Yeah, so right now we have a portfolio that you might say, oh, that's a fairly large cap portfolio. But again, remember, we're unconstrained capitalization wise. There's no reason we would own a large cap or mid or small. It's just, is this company great? What do we think they're going to compound at? And so the companies that tend to be a little on the mid to smaller side, we do get to know our management teams. And so we spent a half day yesterday with one of the new business that we own with the CEO. And it was time well spent. It was a thoughtful conversation. And we had a nice thoughtful conversation around capital allocation. We shared some insights into what we thought were good uses of capital. The favorite book we like to reference is Will Thorndike's Outsiders, and there'll be a copy in the mail tomorrow. But with our larger companies, it may not be the CEO that we're close with, but we're definitely getting to know certain members of the executive team that can inform something important about what we're trying to solve for. So it's not, we don't need to get close, but we often do, and we try to be as constructive and long-term as possible. And just in our class, which might be a question, Scott, I use the class at Columbia as a research laboratory. And, I love bringing in executive teams that we've studied in the past. And so, I have the Mendelsons from Heiko coming in this year. I have Rich Barton from Zillow coming in this year. And we have, Jonathan Gray from Blackstone coming in, and Todd Combs will be with us next week. So it'd be great to get lessons from Geico, from the CEO of Geico right now. So it's fun to engage these great operators from the classroom laboratory, as well as from just the portfolio, management process as well.
Here's a question, Chris, from one of our friends in Europe. We talked about a little bit the opportunity set outside of the US and that it's growing. Valuations and entry points look lower in Europe for fantastic businesses. There seems to be a geographical discount in Europe, or maybe on the other side, a US premium. So how are you thinking about Europe and taking advantage of the growing opportunity set beyond our borders?
That's a great question. I think you'll see our portfolio become more non-US over time. And we like some of the things that we get in the US with regard to private property rights that we may not get in other geographies. But UK has been a very productive place for us, and Canada, very productive place for us. You look at the Grove, and you probably have at least 30% of that Grove is non-US businesses. And so they're on our list. And I would argue that we haven't seen the valuation discrepancy in quality than we have in more traditional value. So we haven't, there's a handful of businesses that were close to 15 IRRs for us, but they just never got there. And we were getting there on, in our 7 businesses that we own, and they just happened to 6 of those are US. But we're looking hard. Trust me, Howden's Joinery is a business we've studied and owned in the past. B&M. So there's a number that we have prices that we'd love to own them at. Trust me.
Great. Let's see here. Question from a Notre Dame alum that we know. Do you take the same DCF approach to valuation regardless of the sector a company's in?
Yeah, we do. And we challenge ourselves too, because we see some of our peers that may look at a 5-year IRR and they're like, we'll talk to them and they're like, oh, this is a 25 IRR. I'm like, I just calculated it as 14. So I think as an allocator too, it's hard when you hear these numbers and it's not apples to apples. It's, the problem I have with short-term IRRs is terminal multiple, right? Because if comparables today, people are paying 30 times sales for a SaaS company, and they said, you know what, I think this is worth 20 times sales 5 years from now. It's still silly math. The highest multiple to free cash flow in our 10-year models that we give to the best company is 20 times. And so we think it makes us more disciplined in that valuation equation in times like this, where it's very easy to say, I think someone's going to pay, X multiple 3 years out or 5 years out. We would certainly have a lot more of those high IRR candidates if we did that. We just don't think it's not something we've ever done. And it's just kept us, I think, a little focused on the longer term.
Just a question, Chris, just thoughts on the opportunity set in China, particularly given some of the recent policy changes. Do you have anything there?
Yeah. One of our favorite questions that we ask every week is where are the clouds? Where are the clouds? There's huge clouds in China. And I think as value investors, you're probably right to look there. And I bet there's incredible opportunities. Charlie Munger, Alibaba in Daily Journal portfolio, case in point. And he's got some insight probably through Li Lu. And that's probably money good looking out 5 years. As a team, we just haven't felt as comfortable. I say yet, we're not doing any active work in China, but there's so many other things that we'd rather work on that we think we feel a lot better going to bed at night and saying, how do we lose? Yeah. Because there's so many things where I look at my probability tree, how does Zach Hauser play bridge? Look at these probability trees. And I just don't know.
Yeah, I agree. I get asked about China a lot, and you do have to take the long view.
Yep.
Every few years there's sort of a crackdown on some sector of the economy for various political reasons. But they're not ultimately going to shoot themselves in the foot and growing their economy and creating jobs. So I'm still bullish long term on China. Some great companies are being built.
I think you're right, Scott.
Let's see, other questions. That's any. I think that's the maybe just wrap up a little, just talking a little bit more about your role as an adjunct professor at Columbia and what do you try to instill in these students? Yeah,
what's really fun, I mentioned that, we just started last week, by the way. I got to visit we have 80 students every year, and we have a number of auditors, and I get so inspired. I go down there, and these are all mostly second years, and just to see their curiosity. And I go in there, and I love the word alchemy, right? Because I go in there, and all of these people from all around the world are all interested in learning investing and getting better and learning about continuous improvement. And I have this wonderful calling card, which is Ben Graham and the history of Buffett taking the class in 51, to go out and get the best speakers in the world and say, can I create an alchemy about these great students who are curious, these great people who have been successful, and bring everyone together and just engage in this incredible learning experience. And it's very inspiring to me to see, what ends up happening from that, the friendships, learning relationships that are built, that expand the network. And you've been a teacher for a long time, Scott. It's very gratifying. These students come back and, maybe you've had a positive effect on their life. So it's a lot of fun. And, I shared some of the speakers, but like I said, we have, got this Frank Slootman, CEO of Snowflake, coming in, Peter Kaufman, Patrick O'Shaughnessy will be there, Will Thorndike, Brad Gerstner. It's just
Fantastic.
it's so fun.
So Chris, people ask me all the time, especially students, what makes a great investor? And I talk often about clarity and coherence of their philosophy. People who are really clear on what they do, it really stands out. Judgment, intellect, energy. This takes a lot of energy for these people to do this work. Humility and resilience. I think resilience is really important. And as listening to you again, as I have over the years, you stand out in every one of those and many others. So we just want to thank you for your work, both for the university, but for Catholic Investment Services and all your great clients. And thanks for being one of those people in the business that just really stands out and is super smart, but also fun to work with.
Thank you so
Chris.
much. Appreciate it. This is a lot of fun.
Chris, let me add my thanks on behalf of CIS and all the folks who are on the phone or on the webinar with us. And to the audience, thank you for joining us. We're going to have a quick audience survey. If you'd hang on for that, we'd appreciate your feedback. It's very valuable. And thank you all for joining us. And please be healthy and safe. That concludes our program. Thank you.
Thank you, Tom.
Thanks,
Chris,
everyone.
thanks again. Thanks,
Thank you,
everyone.
everyone.